Hello,
Good morning, everyone.
Jake. I can hear you.
I can hear you too.
Amazing, incredible. Thank you. We're off to a great start.
This number six, number seven. I'm losing count.
This is number 7. I think this is number 5 for you because you've left me twice, and still working on forgiving you for that. But we'll get there. We're working on it.
For better or for worse. Yes, I turned 30 a week or two ago, and last week went up with a bunch of friends to a house that we rented. So Daniel, thank you so much for covering. It seems that the stream went well. One person actually said it's better when Jake is not there. So we will keep tabs. We'll keep tabs on that. I'm very open to feedback too. So we're just here having fun. It's great to see everyone. Shane, you're funny. Today's going to be a lot of stock talk. So should be fun.
Yeah, thank you everyone for joining. We did not get Nick on the live stream. So unfortunately, Nick has been sick for like a week. I won't get into like the details of what he's going through, but the man is very sick. So hopefully we can get him on next live stream and he'll be better next week. Just, hoping he gets better. Also, I have an appointment. I'm going to get vaccines. I'm going to Asia in January. So I need to go get my vaccines today. So we will unfortunately have to be cutting off stock talk early this week. Last week we went a little bit long, so I hope that can make up for it. But yeah, it's going to be a quick one this week. And to start off, I want to talk about some of the major news that happened over the last week. Now, the really the largest news that I found that I think actually impacts the market the most, I just need to go through my notes here really quick, is the JPMorgan earnings that came out. So JPMorgan reported their earnings yesterday. The stock was up like 3%, I believe. And I think the market was actually quite happy about that, even though the market was down. Jake, have you had a chance to go through the earnings of JPMorgan at all?
No, I have been very busy building transactional-based portfolios, which is a feature coming along in Stock Unlock. So I have a little bit of catching up to do on that.
Dude, no worries. I got you. Can you see my screen?
Thank you. Yes.
Awesome. Okay, so the first thing we're going to go through is JPMorgan's transcript. So this is, if you don't go through companies' transcripts, by the way, it is an incredible resource on top of looking at the company's financials and the reported numbers, because the transcript, like the CEO and the management of the company will go through all of the numbers and really elaborate and break them down. So it's a great practice to get into, and transcripts usually aren't that long. They take like 15 minutes to read usually. So right here, an analyst asked JPMorgan's CFO, the chief financial officer, Jeremy, and I have it underlined right here, and they said, would appreciate any perspective in terms of, are you beginning to see cracks, either be it commercial real estate, consumer, where it feels like the economic pain from inflation, higher rates is beginning to filter through your clients? So basically this analyst was like, okay, are you starting to see cracks within the bank? Like, are people defaulting on their loans? Are loans starting to go bad? Like, what is going on with, just people's credit, consumer credit, banking credit, all of it? Just how is credit doing? And then the CFO responds, yes, I'll take over him. Thanks. The short answer to that question is just no. We don't see anything that you could realistically describe as a crack in any of our actual credit performance. And we do see, in some cases, some tiny increases, but generally, in almost all cases, we think that's normalization, and it's even slower than we expect. So why this is so interesting to me is because, we're seeing a lot of very fearful headlines right now, like a lot of negativity, a lot of pessimism towards the economy. JP Morgan is the largest bank in the world, the largest bank in the US, and the CFO is very clearly saying that credit looks fine. There is nothing to be concerned about. Like, there's no cracks forming. Everything seems okay. So I thought that was very interesting. I have another screenshot right here. This is Jamie Dimon, the CEO of the bank. And this is in response to the same question, if there's any cracks going on. And he says, balance sheets are very good for consumers. Credit card borrowing is normalizing, not getting worse. You might see, and that's really good. So you go in a recession, you've got a very strong consumer. So right away, basically, he's saying that consumers look really good. Credit card borrowing is normalizing. It's not getting worse. And that's a very good thing to see. Then further down, he says money they have in the checking accounts will be depleted probably sometime mid next year. And then, of course, you have inflation, higher rates, higher mortgage rates, oil, volatility, and war. So there are things out there, and that is not a crack in current numbers. It's quite predictable, and it will strain future numbers. So basically, Jamie is kind of being a little bit more bearish and saying, okay, well, things look okay right now, but there are some headwinds on the overall economy. But right now, as of today, things look fine. Like, honestly, quite fine. Now, finally, the last screenshot right here is JP Morgan's third quarter financial results, like the actual numbers that came out. So JP Morgan's net interest income for this year, or sorry, for the third quarter of 2022, 17.6 billion, up 4.4 billion year over year, which is a 33% increase. So with rising interest rates, banks like JP Morgan are making a ridiculous amount of money. Literally a 33% increase in interest revenue year over year. Managed revenue in total for the bank's total revenue was 33.5 billion, up about 10% year over year. So the bank literally reported a record amount of revenue in the quarter that they reported yesterday. Like, it's literally the most revenue the bank has ever generated in its lifetime. And then we can see net income here was 9.7 billion. It was down $2 billion year over year. So net income did decline. But the reason that net income declined is because there was about a $3 billion difference in the reserve build versus reserve release. So what banks do is they essentially set aside money now to protect against the possibility of future loans going bad. This is known as a reserve build. And when a bank does that, if they build their reserve, then it comes off of net income. So if they got to take money away to build the reserve, it goes against net income. Last year, what JP Morgan did is they released money from their reserve. And when the bank releases money from the reserve, it goes towards net income. So it boosts net income. So last year they released 2.1 billion. This year they added 800 million. So that's about a $3 billion difference in credit reserve, just building it versus releasing it. And if JP Morgan was flat year over year on their credit reserves, then net income would have been up about $1 billion. So I think there's a strong argument that JP Morgan is doing just fine.
Yeah.
Like,
I agree. It's I remember we were talking about FedEx on a past show, and I guess as a retail investor, one question I have for you, Daniel, I feel that you can justify any side of the argument you want, whether we're like going into a recession or not, depending on where you look. So when we were looking at the FedEx numbers, you're like, hey, people are shipping less packages, but then we didn't know if that was like just their unique business or if that was pointing towards the larger economy. We also like to look at Visa, MasterCard earnings for spending. So this to me seems like one slice of it. So a question for you, is this enough to say that we are or are not going into a recession, or is this just another piece of a bigger puzzle going on here?
We're always going into a recession.
Explain.
That is, if we're not in a recession, we're always going to be going into a recession because a recession is always inevitable. So if you're not in one, you're always heading towards one. That is like the best answer you can possibly give because no one knows when it's going to happen. Like even Jamie Dimon in the transcript, he was like, he doesn't know when the recession is coming. He thinks we're going to be entering one. Like right now, everything looks fine, but he's like, I don't know if it's going to be, Q2 next year, Q4 next year, but we are probably going to enter a recession. And that to me is just like, why are we even trying to predict this?
I agree. And I guess like as a good takeaway and for myself too, like don't try to predict recessions.
Yeah.
It's not going to help you when you're investing. And your answer is basically like, well, of course one's going to happen, as opposed to like pigeonholing yourself into, FedEx earnings did this, or like some inverted yield curve, or like they bumped rates by 100 points instead of 75.
Exactly right. And Charlie Munger actually has a really good quote as well. That's like, if you understand the economy, then it should really confuse you or something like that. Basically, like, the more you understand about the economy, the less you understand it, and like no one knows what's going on.
Fair. Also, for anyone in the chat, we're going to be doing a handful of stock talk today, or if you guys have questions for us or Stock Unlock, we'd love to interact with you there. Daniel, I'm not sure if we had much more on the JP or any other stories to break this stream.
No, that was the largest news I found this week, and I just kind of wanted to share my perspective because Yeah, it's just interesting. All right.
Uh, we
Yeah.
do have
So
a question from the chat actually. With the recession happening, what are your thoughts on discount retailers? Can you review two specific ones, Big and Dollar Tree? We could.
yeah,
What do you think, Daniel?
I mean, sure, you can always do that. Let me. Oh no, that's the wrong button. Okay. Share my screen. What are the tickers? DLTR and Big. Okay.
Yes.
Dollar Tree. Okay, so right away, the stock is up a lot. Like a lot. Okay. If we compare this to the SPY over the past 20 years, Dollar Tree is up about 1,300%, 1,300% versus the SPY's 200%. So it's massively outperformed the SPY. What do our insights say?
I have a customer insight about Dollar Tree, not to derail us, but very few things in there are a dollar now. I just want to say, when I was a kid, Dollar Trees used to cost $1, right? So it seems like I'd be curious to see how their business has grown over time, and if they're able to, continue to augment and get people to come in the door, even if it's not $1.
Yeah, I wonder if they're gonna have to change their name to like $5 Tree or something.
Well, it's not $1 tree now; it's just Dollar Tree. So it's things that are a few, little bit of dollars, I guess.
Yeah, fair enough. Okay, so I'm seeing that this business has a very low free cash flow margin right now of less than 1%. Not ideal. Definitely not ideal to see that. I would want to know why that is. We'll take a look at that. So growth, revenue is growing 5%, gross profit 6%, operating income, net income growing, but free cash flow decreased to 90% year over year, and operating cash flow is down 40% year over year. So something is going on here for sure. Like revenue is going up, but cash flow is declining a lot.
Yeah. I wonder how COVID affected this business too,
Yeah.
because this is mostly like retail locations. I'm not sure if what their online presence is, to be honest.
Yeah, me too. I like almost know nothing about this business. The shares have decreased over the past year by 2%, so they are buying back shares. Okay. Let's go and take a look at what's happening here.
You read my mind.
Okay, so the revenue, I imagine that this right here is from an acquisition. Like this is just, I don't know what happened here, but I'm going to guess it was an acquisition. But outside of that, that's actually very, very nice revenue growth. Like, wow. Okay, let's zoom in before the acquisition. That's like almost every single quarter this business was growing its revenue, even through 2008. So in 2008, like the business looks like it was fine. It handled the recession very, very well. And then after what I think is an acquisition, I mean the revenue was growing very consistently. That's quite impressive. What's going on with the cash flow here? So cash flow does not grow as consistently, and it looks like operating cash flow peaked in the first quarter of 2021 at about 2.7 billion. Now it's down about 50% from the highs, down to 1.2 billion. So I don't know why this is, but I would want to know why this is if I were considering this business. Like the revenue is growing very nice, but what is going on with the profits here?
Yeah, we
Yes.
might need to. I don't know if we have time for it, but on their investor relations website, they probably talk about if they're like
Yeah.
investing in a new, area of their business where their free cash flow could be going down because they're investing. In which case, you'd hope that they have a high ROIC on that money, and they will start to make more in the future. But it's a little bit hard to tell just from the cash flow statement.
Yeah. Yeah.
Ooh.
Definitely. Like this is what's going to happen. So if the business's operating cash flow is declining, then if you take a look at the price to operating cash flow, what you're going to see is an absolutely massive spike, which is exactly what happened. And now the business is trading for a price to operating cash flow of about 26. So basically, if the company can get its margins back because its operating cash flow margin, um, oops, no, right here, operating cash flow margin has fallen off a cliff. Like it went from 10.6% down to 4.5%. But if this margin can come back, then the price to operating cash flow will compress massively. But again, as Jake said, like I would go to their investor relations and try to figure out like what is happening here. Why did this margin just collapse? And is it a short-term thing or is it going to come back in the future?
Yeah. Thank you for that, Daniel. I'm not sure if we wanted to go much deeper on this one. That we are getting a lot of really great questions in the chat. I'm not sure if you want to just pick one or. And thank you, Vijay. Apologies if I'm mispronouncing, but thank you for dropping that question. You were the first, and we really appreciate you guys all dropping them in. We're going to do our best to get to as many as we can.
Okay. I'll just do this one. It's the most recent one I just read. What is the difference between operating cash flow and free cash flow, and why is it important to take a look at both? So the difference between operating cash flow and free cash flow, operating cash flow shows you how much money the business's operations actually generate. And then free cash flow, so what happens is you take operating cash flow, then you subtract the capital expenditures from the business. And the capital expenditures are the business's necessary expenses to keep the business operating and also invest in growth. So it's basically the necessary expenses plus the expenses on growth. And then you subtract that from the operating cash flow to get free cash flow. And then free cash flow is like, okay, how much money does this business generate after those expenses to, pay dividends, do share buybacks, or just build up cash reserves for the shareholders? So I like to take a look at both operating cash flow and free cash flow because you can go through periods. Let me show you. Oh, Jake, are you sharing your screen?
Feel free to take over. I was just going to put the definitions up on in the back. So, because we have all these up in Stock Unlock, which is very nice.
That is very true. Our education mode has all of these definitions in depth, like very deep depth. But I can show you if we head over to Meta, very polarizing stock, by the way. But what would be the best way to show this? Probably in the free.
Get that education mode on, man. I know you're smart, but
I'll get there. I'll get there, Jake.
I love education mode.
I know. All right, so here's the difference. If we take a look at Meta right now, you can see that the business's operating cash flow is like kind of topping out right here. And the free cash flow is falling off a cliff though. So the reason for this, so the business's operations are like still very profitable, but the reason that the free cash flow is dropping off a cliff is because they're investing like billions of dollars into the metaverse. And that is a capital expenditure. So the actual operations of the business are still very profitable. But when you subtract the investments that they're doing into the metaverse, then the free cash flow you can see is dropping quite a bit, quite substantially, like a lot. And this is why a lot of investors are also bearish on Meta right now, is because they're like, well, the company's investing billions of dollars into the metaverse. It's lowering free cash flow. And no one knows if those investments are going to pay off in the future. But yeah, that's why I like to take a look at both.
Yep. And I'd say as value investors too, if you want to compare like a net income to a free cash flow, this is just our opinion, but free cash flow can be a little bit more consistent. Net income can include one-time buys and sells as well as unrealized gains or losses, which can really, I mean, we could talk about that for a while on its own, but that can really throw off some numbers. So it's always good to look at both. And if you are just looking at one or the other, like going deeper on this company to understand, as Daniel said, is this company making investments? Like what's influencing these values?
Yeah. And then as Jake said, like our education mode, if you go on Stock Unlock, turn on education, go and read the free cash flow, how investors use it. And this is like a much more and well articulated explanation on what free cash flow is.
And you wrote all those, right? I mean, in Stock Unlock, if you're unfamiliar, hundreds of those question mark widgets stuff to find everything you're looking at. So we're very beginner accessible, even though I've been investing for a while too. I like to leave that on because, of course, there's always a term or two where you're not going to remember every single one.
Yeah, just so everyone knows, education mode was written by me, and the Google Doc is about 200 pages long. It took a long time to write that.
That's not including so there's education mode, but then on the insights, if you click on an insight, there's an explanation for that. I think Daniel has probably written the equivalent of a textbook that we have hosted, all unique within Stock Unlock.
Yeah, the insight.
Check it out.
The insights doc, I think, is about 90 pages. So between education mode and the insights doc, I think there's 290 pages of education. It's like a book. It took a long time.
Took a long time to copy and paste those into the code base too, but I think that was a little bit more of a menial task than actually being creative and writing them. But my eyes were bleeding a little bit after like the 200th page.
Yeah. Okay, so here's another question. Thoughts on HPQ? So HPQ is a stock that Warren Buffett has been buying recently. I think he bought like $4 billion worth. I actually think he owns 10% of the company now. This company makes HP laptops, so and HP printers actually. I think HP printers is like half their business almost. Anyways, this business is generating like a ridiculous amount of free cash flow. Here, I'll actually show you guys. Let me
We
share
need a
my.
shirt, like a Stock and Lock shirt that just says "We love free cash flow" or something.
Yeah, we really love free. Whoa, I just about spilled my coffee. We really love free cash flow, and so does Warren Buffett. And I'll show you exactly why he is buying this business. So, HPQ right now in the trailing 12 months has generated $4.6 billion in free cash flow, and the business has a market cap right now of about 26 billion. So Warren Buffett was taking a look at these numbers right here. I'll zoom in. I believe that Warren Buffett was taking a look at these numbers right here. You're paying $26 billion for about $4.6 billion in free cash flow, which means that this business has a free cash flow yield right now of about 17.5%.
Whoa!
So yeah, so basically
Wow.
if HPQ wanted to pay out 100% of their free cash flow as a dividend to shareholders on the company's share price today, on the market cap today, then it could return a 17.5% dividend to its shareholders. So I think that Warren Buffett was taking a look at this free cash flow yield and was like, this is way too juicy to pass up. Also, if you take a look at Occidental, this is another, like, Warren Buffett, I think, is trying to buy out this company. The Occidental right now has a free cash flow yield as well of about 18%. So I think Warren Buffett, again, is taking a look at these free cash flow yields on some of these businesses like Occidental and HPQ. And he's just like, these yields are way too high. And I think he's taking advantage of them. Like, again, right now, if you take a look at both, they're both sitting around an 18% free cash flow yield right now. So yeah, that's why I think Warren is buying. Oops, I just tried to type revenue in the wrong spot.
I actually did that the other day.
I do that all the time. If we take a look at HPQ's trailing 12 months revenue over the past like 5 years, though, the company has grown its revenue at about 6% a year. I actually don't know how much it's growing its free cash flow. Free cash flow has grown at about 4% a year. So in my opinion, though, Warren Buffett isn't buying the stock as like a massive growth investment or anything like that. I think he's basically buying the stock because it generates so much free cash flow. It's returning so much cash to its shareholders. And I think he thinks that it's going to be able to in the future. Like, if you take a look at HPQ's shares outstanding over the past 5 years, this company has bought back on average every year 10% of its share count. And this is on top of like how much of a dividend does this company pay now? It's got a dividend yield of about 4%. So it's got a 4% dividend yield. And on average, it buys back 10% of its shares every single year. Like,
can we go to the dividends tab? I'm curious what the dividend yield on cost is over time. And I want to highlight something you said, which I think is very important. You said, and Warren Buffett also thinks that this company will turn these free cash flows in the future. So one very important thing that you don't see from looking at historical financials is if you were to make investment in companies like this, research their business and have confidence that not only are they making that cash flow today, but they have the moat and business expertise to continue to execute and do that in the future. Very important second piece.
Yeah. Yeah, you always have to consider a company's moat. Like, for example, okay, HPQ may have a 17% free cash flow yield today, but what does that matter if next year the company's business is going to go under? Or even if, maybe not go under, but what does that matter if the company's cash flows are going to drop by 80% next year, right? So if the business does not have a moat or a durable competitive advantage that's going to allow it to generate those cash flows over the long term, then there's a pretty good argument that a high free cash flow yield today is almost meaningless.
Yeah, I would look at IBM too. I think that's an example of, I'm not sure for free cash flow yield specifically, but big tech company where 20 years ago people thought it was one of the best investments, and if you look at their revenue and their growth over the last 2 decades, it's just flat or declining, and things like that can happen. So really got to try to put on your future glasses there.
Yeah. Also, the shares have been increasing. Oh no, never mind. Yeah, IBM right here. I believe the business's revenue has been downtrending since 2012. Like, the business's revenue downtrended for 9 years straight. And I believe that's the same story as the free cash flow. But yeah, you can see the free cash flow has been downtrending for actually about 12 years. Now, what's interesting about IBM is if you take a look at the free cash flow yield, it's currently about 6%, but this business has historically sold for an average free cash flow yield of about 9%, which looks pretty good, right? But if you go to the free cash flow yield on cost, since this business's free cash flow is declining, it means that if you bought this business back in 2012, after waiting 10 years, your free cash flow yield on cost now is about 3%.
Yikes.
Yeah, because the business's free cash flow has actually declined.
And their stock price does follow that too. So if we were to look at like the market cap or stock price, going back in time, if you had a time machine, you would not be buying IBM stock 10, 15 years ago. But looking at the historical financials relative to that point, that's where it gets a little juicy, right? Because you have to try to like be really smart about if this company, as we're saying this whole time, will continue to grow. But yeah, this is a great example, Daniel. Love these new metrics that we're adding.
Yeah, right. But yeah,
Let's go.
But you can see, like, okay, if you purchased IBM in 2012, at the time, the business had that free cash flow yield of 6.6%, right? But again, you can see that the free cash flow yield on cost now has dropped all the way down to 3.16%. Again, because that business's free cash flows, they actually ended up declining over the next decade. So the free cash flow yield on cost dropped significantly, which ultimately led to the stock price also dropping because stock prices follow the company's profitability.
I don't know if we have time for one more. I am thinking about your time, Daniel, because Daniel has an appointment today. So we got to make sure that he makes it to that appointment on time.
Yeah, unfortunately. Gotta go get my vaccines for my trip.
Nice. Well, feel free to call the shot here, man. Always love hanging out with everyone.
Yeah, for sure. Okay. Wow, we got a lot of comments. I did not see. When I'm sharing my screen, by the way, I can't see all the comments, so I'm really sorry about this.
I got you. I wish that we could get through all of them, but it's a resource constraint issue.
Yep.
Engineering red flag.
Thoughts on... Wait, all right, really quick. You think we can be heading for a depression? If so, how would you prepare? I mean, okay, if no one can really predict a recession or when the next recession is going to be, then depression, take that uncertainty and multiply it by 10, basically. So I don't know if we're going to be entering a depression. I freaking hope not, because that would really suck for everyone. If we were going to enter a depression, though, how would you combat that? I would say the best thing you could do, even during a recession or a depression, in my opinion, is probably like just stay employed. Like, make sure that you can keep paying your bills. And the best thing, in my opinion, for an investor also is to make sure that you as an individual have free cash flow coming in every single month. Because if you have free cash flow coming in every single month, then like you can, if the stock market drops 90% in a depression, then you can dollar cost average through that every single month, and it will help you emotionally. And yeah, so
Yeah,
I think like staying employed and having your own personal free cash flow is just like a superpower in investing, and I think it's very important.
yeah. I would say on top of that, and not financial advice, of course, but this advice would apply to any time, not just preparing for a recession, but two things. And this is just a review for us. Like, keep your expenses low, right? Like, the reason why you keep your expenses low is so that you can either build up cash reserves or pay off debt. I would always avoid going into consumer debt. Like, probably not a great time. I would argue maybe not ever to go into huge debt to buy a flashy new car that depreciates in value. But people who have high amounts of debt, depending on what those interest rates are, you can unfortunately be in a spot where those interest rates are variable according to rates. And you really want to make sure that your cash flow and stuff that Daniel was talking about, if you're fortunate enough to have it, is actually going towards essentials, food, things like that, not debt payments to a creditor with a bunch of people partying on yachts who are like running the credit card company. We don't want them to get the money. We want to keep the money.
This might be a tangent, but interesting story. So over the past couple of years, even on the YouTube finance space, like I have my own other YouTube channel, and what I've noticed is a lot of these other channels, like as their channels scaled, they also took on more expenses. So like if their channels popped off, they would go and buy new vehicles, take on debt, hire employees, like just leverage the business. And now I'm seeing some of those channels disappear. And my my channel has always stayed like very lean. I keep my costs low, just like even as I run my own business. And that has allowed me to survive like this downturn and remain free cash flow positive as an individual during a downturn. So yeah, I think that staying lean as an individual is like almost just as important as a business staying lean so that you can survive downturns and like it won't affect you um that much. Agreed. Shane Kelly says agreed. I own my old 2001 Nissan Maxima. Dude, before before I met my girlfriend, I was driving a 2012 Nissan Micra, which is basically a step above a smart car because it cost me like $20 to fill up and it would go like 700 kilometers on a tank. Like my girlfriend, by the way, right now, I don't know if you guys can tell, but like she did a pretty good job, honestly. But my girlfriend is currently cutting my hair just to save a little extra money so that I can dollar cost average a little bit more.
Or you just don't get a haircut, by the way. That's the cheapest way.
Yeah,
I have you guys beat. I owned a 96 Honda Accord for a while, and I don't have a car anymore, but I don't have you guys beaten that I live in New York City, so I can take some hate for that. But yeah, owning an old car is awesome.
Yeah, okay, we got a question right here. Hi guys, I have a question and I hope you can help. What are your thoughts on Alibaba? It is a very controversial business, but its fundamentals are I'm assuming are sound. Jake, what do you think?
Full disclosure, I am a Alibaba shareholder. I actually purchased a share yesterday, so this is not financial advice. We're not going to directly tell you to buy or not. What I can say is the fundamentals look great. It's a very strong company. It's also operating in China, where the CCP really much controls all these companies, basically, and they're definitely thwarting innovation there. So on one side, I think from a value standpoint, if you're just looking at financial metrics, this is a company that is incredibly well priced relative to what it's trading before, just based on pure math and statistics. Of course, the reason why it's really controversial is a lot of the issues in China, as well as a lot of question marks on their growth. I think as for myself, I'm a software engineer. I do a lot of analysis on their Alibaba cloud performance, as well as their penetration to other Asian countries. So they're not just in China. They're trying to expand to Indonesia, other places. So for me, it carries enough risk where I'm not going to let it grow to more than, let's just say, like 5% of my personal portfolio. Those are my own choices for my own risk profile in this stock. I'd just be incredibly careful because nothing's set in stone. And I would be lying if I said I'm confident this business is going to appreciate in value. I'm bullish enough where it just looks attractive and cheap enough at this price where I'm very lightly nibbling dollar cost averaging on some shares, but it does carry risk. And like this very well could be, if some crazy geopolitical things happen, like a stock that almost goes to zero, right? So with all investing, just be careful. And my not financial advice, but what I would do is just don't throw all your eggs in one basket here and really try to see both sides of the coin on this one.
Yeah, so it sounds like you are mitigating your risk by not making it a huge position.
Exactly. If it goes to zero, I'm not going to be on the streets. I will lose some money, but it's not something I'm betting the farm on.
Yeah, and I will echo exactly what Jake said. Full disclosure, I also own Alibaba shares, but it has naturally declined into like a 2 to 3% position in my portfolio. And like Jake, if it got to 5%, I would probably start trimming it just because like I don't want that much exposure to Alibaba. But also, as you said, Jake, I think Alibaba basically is like the Amazon of the Asia Pacific region. As you said, like they're expanding into Indonesia, they're expanding into Thailand, like all those countries. And Thailand was one of the fastest growing economies in the world last year. Like Thailand's economy is absolutely booming and growing like ridiculous growth rates, like 8 to 10% a year consistently. And Alibaba is like planting seeds in that economy to be the Amazon and the AWS of that economy. Same with Indonesia. So I agree with you. I think it's not just a China play. I think it's a play on the growth of basically the Asia Pacific region, excluding India, because India and China are not friends.
Fair.
But that's why I own HPV.
Yeah. That was a great question. Thank you.
Yeah, that was a good question. Let's take a look. Jake, how are you doing for time?
I do not have an appointment after this, so I'm going to be the bad influence here. That's like chanting one more stock, one more stock. So you got to just pull the plug whenever you got to leave.
I'll pull the plug whenever I got to leave. I haven't gotten a text from my girlfriend yet. She has the appointment with me. Basically, by the way, she basically is my life manager at this point. Like, she is so much smarter than I am. So yeah, I'm not getting in trouble yet, so we're good.
What's her rate? I could use a life manager.
Honestly. Okay, AMT. This I want to talk about this stock because I've actually taken a look at it recently.
What company is this actually?
This is American Tower. Do you want to share your screen, or are you about to share your screen?
Nope.
Okay, it looked like you were some suspicious activity over there.
I'm just trying to hack people. Yeah. No, we're all safe. No worries for now.
Okay. AMT. So basically what this company does, the easiest way to understand this company is like they own, I think it's over 200,000 cell and data towers, not just in America, but around the planet. So basically the thesis on this business is if the global economy is going to continue using data and growing their data usage, AMT's business should grow and thrive because they essentially they supply the data, basically. This company, it was worth $4 in 2003. It's a $185 stock today. At the peak here, it was a $300 stock. So over the past 20 years, it almost 100x'd, okay? When you compare that to the SPY, the stock is up, 5,000% over the past 20 years versus the SPY's 300%. So it's massively outperformed the SPY. But here's the thing. It has been tanking recently. It is down, what is this? It's down like 40% from its all-time highs. One, the stock was expensive right here. I think it got a little too expensive. Like, people just got too bullish on it. Yields got way too low. Now the stock is correcting. Free cash flow yield now, FFO yield, because it is technically a REIT, is about 5%, even after a 40% decline, okay? But the thing about this business is if we head to its balance sheet, actually, if we go to our insights tab and the financial health is a 2.2. Intangible assets are almost 50% of the total assets, and the tangible book value is negative. So this business has a lot of debt, basically. And with rising interest rates right now, like what I'm noticing with rising interest rates is companies that have a lot of debt have been tanking in the market over like the past month. So total liabilities, where is total liabilities? Right here. Yeah, so this company has like $61 billion of liabilities or debt and assets of about 68 billion, but about 33 billion of those assets is intangible assets. And also what's interesting here is if we take a look at the company's operating cash flow, it hasn't really been growing since like 2018. Like, it's been growing kind of, but like not really that much. Whereas the revenue has been consistently growing. So what that means is the company's operating cash flow margin has been coming down. So it's been losing profitability as time passes as well. And then on top of that, there's kind of like, I've done quite a bit of research in this company recently because I was really considering buying it. But on top of that, it doesn't have like that much free cash flow. Like, take a look at this. The free cash flow in 2018, 2.84 billion. Right now it's 2.82 billion. So over the past 4 years, the company has not grown its free cash flow. And I don't love that.
If there's time for it, I do have a little insight from the engineering side of things potentially on this business.
Yeah, sure.
Before I say this, I just want to say I have not spent any time deeply researching this company. So what I'm about to say is pretty hand wavy, but it is important for anyone taking a deeper look into this as an investment. This statement also applies to semiconductor companies and like anything in the tech space. But for this specifically, you said they build cell towers or they own a lot of the data transfer. I'd be very careful where this industry is going in the next 5 or 10 years. I think technological advancement is an exponential growth curve We are on that now. And just look at things that Tesla is doing with Starlink. I know Amazon's coming out with those. No, it's not the exact same product, but I don't know how much of a moat this company has. Maybe for the past couple decades, they were able to build a moat and a monopoly around some of these towers and things like that. Again, I would need to do more research, but if you're looking to invest in this, I would look to see how they're augmenting their business to change with changing technologies. How old are the people running this company? Are they able to stay up with the times? Because I would be really skeptical as a shareholder if they're going to be able to continue to generate the profits and cash from this infrastructure today as they will in 5 or 10 years, because I think these technologies for the consumer are going to get cheaper and cheaper and potentially be deployed in different ways. So be really careful there.
No, that's a really good point, actually, because when I was taking a look at this company, I was thinking about Starlink as well. Like right now, Starlink doesn't have the bandwidth to support like a full-on economy. But I mean, as technology advances, what is the best way to put this? Okay. If you had the option between using a data tower versus Starlink, and like data limits were not a problem, okay? I can almost guarantee that every single person would be like, I want to use Starlink because it's faster and it covers the entire planet, right? Like it's a no-brainer. You want to use Starlink. So what that tells me is people will probably prefer Starlink in the future if Starlink can actually support the bandwidth of the global economy. And as technology advances, that's probably going to happen.
Yeah, I'd say even for the consumer, like they might not even be looking at the name. It's just what's the best internet access at the cheapest price. It's all about experience. Exactly. And not to go too crazy on this, but what I have heard, there's going to be multiple companies in this space. So Tesla and Amazon are already going in, creating those low orbit satellites. People are building layered software on top of that, where you can, cheaper than a current provider, wrap multiple like satellite providers on a proxy where you could actually load balance between the two. If one goes down, the other goes up. Like we are going to start heading into like a different era of what like consumer internet means, and like the redundancy there, your ability to choose providers. And it is likely, not to quote Kathy Wood here, but I think she's right in that at least for this specific area of the economy, we can see a lot of deflation when it comes to consumer prices to like access the internet and things like that. So it's just very unclear, and we're going to make a bet that we're not really experts there, and probably no one else in the chat is either. So just be careful when you're looking at companies like this, because historical performance is just one part of the picture.
Yeah, exactly. Yeah. And just to wrap up AMT, I mean, even after a 40% stock price decline, the company is still selling for a price to free cash flow of 30. And I just think that's like quite expensive personally. I mean, if you take a look at the free cash flow yield on that, then probably going to be around 3%. Yeah, 3.3%. And when you compare that to a 10-year bond right now, which is almost 4%, it means that AMT's business right now is actually not even yielding the same as a 10-year bond. So in the words of Benjamin Graham, this company has no margin of safety, right? I mean,
fair.
I just think the price is kind of like not amazing.
It's an interesting one for sure.
It's a very interesting one. Definitely interesting.
Thank you for that question.
Yeah, it's a great question. Okay. Okay, this one right here. Why are utilities falling even with high yields BIP? Yeah, so this kind of goes back to what I just said about AMT. Typically, utilities take on a lot of debt to grow and expand. And with rising interest rates right now, like I think over the past month, the market kind of came to the conclusion or the consensus that like interest rates are going to continue rising. And if interest rates continue rising, then companies that take on a lot of debt to operate are probably going to struggle more. And that's why the entire utility sector just like sold off like crazy. Like it was almost downright panic selling in the utility sector over the past month. Like if you were holding utility stocks, it was like a 20% correction. It was nuts. And I also think that applies to companies like AMT. Like technically AMT is not really a utility. Well, it probably is considered a utility. But yeah, I think that's also why AMT went down, is just like the companies with a lot of debt in high interest rate environments like this, I think investors are selling off. With that said, though, I bought some more utilities last week Full disclosure.
When people sell, Daniel Pronk backs up his dump truck and just shovels in shares.
I was waiting for one. The one I talk about on my channel, Capital Power, because they don't have a lot of debt, man. They're like a pretty clean balance sheet, generating ridiculous amounts of cash. They got sold off with the entire utility sector. So I was like, eh.
Well, we'll see how that plays out over time. Yeah. One thing that's cool about utilities is their moats, because usually there's lots of like laws in place wherever they operate where like they can be like the only operator. So that could in some sense like make them, quote, easier to analyze, at least from like a moat perspective, just like getting understanding there. So yeah, like you said, when everything drops at once and 20, 30 stocks drop, there's probably one or two in there that might just be moving with the trend. So if you're able to identify and have confidence that some of those might be outliers in the future, great time to consider nibbling on positions.
Yeah, I agree. I like personally, I love when an entire sector just falls together, because it's like, if you know what the best stocks are in those sectors, I mean, sure.
Yeah, I mean, I've been dollar cost averaging slowly into Microsoft and Google as they fell. I got a little bit lucky on this, but I was not buying. The last share of Microsoft I bought was when it was at $214, maybe before COVID. And then it ran up and it was trading on a price to free cash flow. I think it almost like maybe touched 40. And you were talking about it at your channel. It's like, this is just so expensive. And I was like, I agree. Like, I just can't justify it. And like now as it's coming down, it was like below 230 the other day. I was like, yeah, I'll start nibbling on shares again. So using these pricing metrics, and the reason why I'm saying this is Microsoft is moving down, like with the market, and obviously like Apple, Google, like whatever tech giants you want to say are kind of falling together. So same mindset there. If you think that some of those stocks are still good and will be around and grow, want to buy them when they're going down, not when they're going up.
Yeah, I agree. I just agree. I think when stocks are going down, it's a great thing for long-term investors. Like, honestly, I love it. I think the market we're in this year is so much more attractive than the market we were in over the past 2 years. Like, yeah, I'm loving the price action we're seeing. The Secret Reefs says many utilities seem to swing really wildly month to month, though. There are constant dips and rises, many of them. So there's some kind of cyclicality. Sorry about me being bad at English. Happening, maybe. Yeah, I would say cyclicality towards the stock price, not really cyclicality towards the company's fundamentals, though. I mean, if you go and take a look at Fortis, just go and take a look at how consistently that business grows over time, because as Jake said, like, Fortis has contracts with the government where they are like the utility provider in Canada. So it's like, and the company is able to grow its revenues and its cash flows with inflation. Like, that is built into the company's fundamentals and financials, because utilities are just such a key thing to the economy. Like, if utilities go down, that's not good. The government does not want that to happen. So like, utilities are backed by the government. They have government contracts. They benefit from inflation. And honestly, I would just go take a look at Fortis's revenue growth and operating cash flow growth, and just take a look at that line going up so nicely. So yeah, the stock prices may be cyclical, but the fundamentals, what actually matters, in my opinion, on a lot of utilities is not cyclical, which also means that if the stock price wants to be cyclical, then you can get some really good opportunities. And I think over the past week, we saw some really good opportunities, just in my opinion, not financial advice. But yeah, I think if people want to sell off utilities, there's some of the most consistent and best businesses to own over the long term.
Yeah. No, plus one to that. I do want to do a very quick shout out to the Secret Reefs. We appreciate you sending us a lot of good suggestions through email. He has contacted support@stockandlock.com. So if you guys ever have suggestions for us, please let us know. Daniel, also, I have a weird request for you. Can you say cyclicality 3 times fast?
Cyclicality.
All right, you'll get a 5 out of 10. It wasn't that fast. It was fast enough.
I learned quick.
You did great. You did great.
This is an interesting one right here. SM Finance. Fortis cash flow is not the best, which is why I stay out of it. Yeah, totally. The company essentially takes all of their operating cash flow plus more and invests it into more future growth. And the reason the company does this is because, again, their their cash flows and their revenue is so consistent that the company basically doesn't worry about them not coming in the future. So they leverage up their cash flows, their operating cash flow today, to invest in more growth because they know it's going to continue coming in. So I mean, it makes some people uncomfortable, and it's totally fair, by the way. Like, if that makes you uncomfortable, then like don't freaking buy the stock at all. And that's fine. But that's the reason why the free cash flows are negative. But if you take a look at the operating cash flow, it's just growing and growing and growing. Cavano says, I bought some utilities recently, pretty nice dip. I agree. I bought some utilities last week as well. One I am currently investigating is Canadian Utilities. It is the company with the longest track record of dividend growth every single year in the Canadian markets. I believe it's over 50 years now. So for the past 50 years, they have grown their dividend every single year. So for a dividend income growth investment, I think it's great. And I believe it's in about a 30% correction right now after the utility correction in the market. So I'm researching that one. And if you're looking for a research candidate, go and check out Canadian Utilities. It looks pretty freaking solid as a utility play.
Yeah, and a shameless plug for Stock and Lock, of course, what we are building here, our company, we are building a stock screener originally around our unique insight scores. This is in development right now. It's not launched, but if you like all the research we're doing, we're going to make it easier and easier to discover and find stocks to take deeper looks into. And thank you, everyone who's been around here to support us. We, as Daniel will say, we really do appreciate it.
As always.
That is one of your quotes. I love it, by the way. It's a brand.
You gotta let people know you appreciate them. Like when I was working on the railroad, another tangent, but when I was working on the railroad, like one of the things that I wanted my bosses to say to me was just like, I appreciate you. Like you're doing really good work. So you just let people know you appreciate them, man. It's great.
I appreciate you, Daniel. I think you're doing really great work.
Thank you.
not asked for it at all.
You caught my hint. No, I'm kidding.
Yeah.
Okay.
I guess this appointment is getting pushed back. I love this, but
well, it's. I mean,
no text from the girlfriend yet.
I mean, she's not even home yet. So, like, when she gets home, I'm just gonna, dip and hop off and be like, "Oh yeah, we ended a long time ago, no problem." And then she'll watch it later and be like, "What are you doing?" No, I'm just kidding. I'm just kidding. I don't lie to my girlfriend, but it would just be a joke. Would be cool. Okay, anyways.
Next comment.
Yeah, let's move on. The Secret Reefs again says, would be cool to see utility-specific metrics in stock unlock like you do with REITs or banks, because most utilities have pretty low insight scores, but are better businesses than most scores might suggest. I agree. This is something we really wanted to do. And hopefully when we improve our data, hopefully by the end of this year, little tangent again, we are going to be getting an additional data provider that is going to give us more metrics and more just deeper insights into companies' financials. And when that happens, we will most likely be able to do this with utilities. But right now, I did a really, really deep dive on our current data, if we can make utility specific metrics. And the conclusion I came to was like, we can't yet. Like the businesses are just very finicky. So we're going to be working on this, and it will come in the future. But I think we're going to need more data to really do this well. I don't think we could do it well right now, basically, which is why we're not doing it.
Agreed. Yeah. From the engineering side, really looking forward to integrating with more data providers.
Oh my goodness.
Yeah, we have a very high quality bar though. So great question. And the answer is we're working on it.
Yeah,
we have an open I was gonna say we have an open Discord. So if people have suggestions, drop in there. We're always there to talk.
Yeah. We have looked at and probably taken meetings with about a dozen data providers now. Like we are very, very selective on who we choose to partner with. And we believe we have found another data provider that's really strong. And like kind of no one's using them. We're not going to name them because I think they're going to kind of be like our secret weapon. So
we'll figure it out. Yeah.
We're going to have to disclose it on the website. But before then,
we want to take another stock here. I'm seeing so many. I see XHR. Have you ever checked out Danather? Can you take a look at IRDM? Have you taken a look at AWK? That's a funny ticker. I actually see 2 requests for EXR. Oh, it's from the same guy. Omer. I haven't heard of that ticker before.
I haven't either. There's a question here. What do you think about REITs and banks, EQV and DIR? The price to book value is below 1. Yeah, so full disclosure, I own both of these stocks. Just so everyone knows that. So I might be a little bit biased right here. But I think that the underlying fundamentals of... Okay, so I got to be careful here. I don't think that what I'm about to say applies to every single REIT or every single bank. I think that there are attractive REITs right now and attractive banks right now, but I don't think that every single one is attractive. Dream Industrial, for example, if you go and read their most recent transcript from the second quarter, the company basically said that they are not seeing any weakness to their business at all. Like, the fundamentals of the business are growing. They're still seeing strong demand. And the business now, I think, is selling 40% below book value. So, I mean, I've been nibbling. I've been dollar cost averaging Dream. Equitable Bank, the same story there. In their most recent transcript, the company reports earnings at the end of the month, which I'm very excited for. But in their transcript, they said, we're not seeing any weakness. Like, our business is fine. We're still growing. We're reaffirming our guidance for the end of the year, which is 10 to 15% net income growth, revenue growth to the entire business. Now it's selling for below book value. The price to earnings ratio is 5, which I really like. So I'm dollar cost averaging that one as well. And until the fundamentals change of those businesses, I'm just going to continue buying because they look great, in my opinion, and they look very cheap.
I don't want to kick on this one too much, but I did just load EXR, excuse me, in Stock Unlock. It has an insight score of 4.33, and I'm seeing a lot of green. This actually does look like a REIT. Yeah,
if I remember correctly, you guys, I take a look at so many stocks, okay?
No, wait, you do? Do you like stocks? I had no idea.
Like, man, it's a problem. So, off my memory, is EXR in the self-storage space?
Their name is Extra Space Storage. Yeah. So I haven't taken too much of a deeper look, but let's make an assumption that they are just based on their company name. They're headquartered in Salt Lake City, Utah, 4,300 full-time employees. They IPO'd in 2004. They own and operate storage units.
Yep. So I think we've said this before on the stream, but the self-storage industry is like, it's just growing so fast it doesn't even make sense. These have been some of the best stocks to own. Yeah, exactly. NSA, EXR, Cube are all good storage REITs. I totally agree. These companies have massively outperformed the SPY. They're growing their dividends. They got great dividends. And they've been tanking in the market as well, because the same thing with AMT, the same thing with utilities. Like, these companies typically do have quite a bit of debt. REITs in specific, or in general, sorry, do have quite a bit of debt. So companies with a lot of debt have been tanking in the market. But EXR, I mean, fundamentally, it looks like a great business. I don't know what the price is of the business right now. So, yeah, I would take a look at the price.
Yeah, this is their long-term debt over time, as you said, steadily going up. But of course, can they manage that? Can they pay it off?
What's their operating cash flow doing?
You want me to bring that up in the free form?
Or financials?
I like this, though. Yeah, let's look at their operating cash flow. Feel free to instruct my clicks around, but yeah, let's move it out with TTM. So
there you go. Look at you.
That's what I do. Right? Dude, I know how to make the website. I'm coding, right? Or we're coding. I mean, the growth rate here is pretty nice. So, like, I actually like this checkbox here. You could just see period over period what the growth rate is. We do have feature requests around this to show overall for the time range and stuff. We are working on that. But yeah, I mean, steady growth actually looks like... I was going to say it looks like it upticked a bit, but not by much. But it's still very steady. Just nice to see.
I mean, 9% quarter over quarter trailing 12 months operating cash flow growth is strong.
I mean, yeah, look at this all-time high they actually made the last report they had. That is great.
Okay, so if you go to TTM again, sorry.
No, you're good.
Go to TTM. What is the actual absolute value there? in the most recent
This
quarter?
is 1.13 billion.
Okay, and what's the market cap?
22.34 billion.
Yeah. So the price to operating cash flow is about 20, which, then my next thing there, like that is decent to me. So then my next question there is, what has the historical price to operating cash flow been, which is exactly what Jake is doing right now.
Dude, it's like we're in sync or something.
Right?
How does this
I know.
happen?
I know.
Well, it looks like it has peaked twice, but I'm going to just kind of eyeball this. It looks like it's maybe averaging around 17, 18, and it seems like it's starting to get down to those levels. It's maybe slightly higher than it was before, but it looks like, at least for the past 10-ish years, with maybe one or two exceptions, anytime it dips below or is about to touch 15, it looks like it bounces up. This is not a technical or telling you that's when you should buy, but just observing how this business has been priced relative to the operating cash flows that it pulls in.
Yeah. If you actually, like, what I like to do is take a look at the past decade. So yeah, I would zoom into like 2012, and then I would look at the average right there. So the average over the past decade has been about 21. Right now, the stock is selling at about 20. So it's selling slightly below its 10-year average price to operating cash flow. The lowest it looks like it gets, at least over the past decade, is about 15. So yeah, I mean, relative to its history, it's selling below its averages. It looks like it's still growing. So
Love
yeah,
it.
yeah, looks like a good research candidate, that's for sure.
Yeah, and like I love looking at stuff like this too, because it's like people might be asking, like, why do Daniel and Jake care so much about price to operating cash flow? Well, when you price something on a price to operating cash flow or any other cash flow metric basis, if the company is growing steadily or has predictable, cash flows, this ratio will like stay within a certain band, which is what we're seeing on this dotted blue line, right? It'll peak up sometimes, but it will eventually hit a cap when it gets too expensive. We also pointed out it seems to bounce at around 15. This is steady. However, when you look at their market cap, obviously, their market cap has a compound annual growth rate of 25%. That is very, very great. That is why we see that's been beating the SPY. So tying both of these things together, the price of the business over time has gotten more and more expensive, which is great for long-term shareholders. That means that the values of your shares are going up. Obviously, that's good. But because they're also growing their operating cash flow at the same time, that's where you see the consistency on that metric. So this is where long-term investing gets exciting, where when you can identify companies that grow and you're confident in their growth, you start getting lots of payments over time based off the discounted price you paid off of what a future projected cash flow would potentially be. And we see that playing out here.
Yeah, like as businesses grow their cash flows and the amount of cash they can return to their shareholders, the price naturally goes up. Jake, this is a fun question for you.
Oh God. Okay, what a person need if someone wants to work with you guys? Send me an email, Jake, Jake, at stockunlock.com. You could probably predict what Daniel's email is also. We'll see if we regret saying this on the stream, but they're not really that private. We take emails from people all the time. I love hopping on calls with anyone for anything related to consumer finance, or if you have your own business that you're running and you want to work with us, reach out. We're super friendly. We're also super busy, but obviously the door is always cracked open, and you never know unless if you try. So we would love to hear from you guys, even if it's just hey, I love your stream, or hey, your stream sucks, but here's a reason of how it could be better. Like, we love constructive feedback too. So send it all over.
Agreed. Daniel Workman says, Daniel, I live close to Dream Industrial's headquarters in Toronto, where they have many unoccupied business spaces and related postings. Just anecdotal, but makes me nervous. That's very good to know. Yeah, that's very good to know. I'm going to be watching their next quarter, essentially, like very closely. And we'll see how this plays out in the company's fundamentals. Hopefully everything remains all right.
Daniel looking spacey. We're going to assume that means that it looks like he's an astronaut about to go to space, because that would be awesome. But
what does that mean? Like, what
explain yourself.
What specifically does looking spacey mean? Interesting. Maybe I'm zoned out. I have no idea. Self-storage.
You look good to me, man.
Thank you. So do you.
Thank you.
Self-storage has been hard to buy into for the last few years because of their intense growth. So finally, there's a bit of a margin of safety on those to nibble on. Recent presentations, all positive. Yeah, I agree. I actually follow someone on Twitter who owns, operates, acquires self-storage facilities specifically. And he's just been posting like anecdotal evidence of what he's been seeing in the market. And he was like, yeah, I bought this self-storage facility for, let's say, 300,000 in 2019. It's worth $2 million today. And like he'll just post these on Twitter for everyone to read. And it's like that's how much demand there has been just to acquire these facilities. So I mean, the correction that we're seeing in the self-storage REIT market and the public stock markets, I think is great.
Yeah, one thing I see too, like just having a pulse on people on like TikTok and all that stuff, where it's like, oh, hey, here's side hustles and all that. It seems that the barrier to entry to own storage units is pretty low. So I don't have a big handle on the space, but I know that there like has been a big boom. I would question like how long that would last for, and then also just look how easy or hard it is to like buy and create a storage unit facility. My argument here is it's actually not hard at all, and it's turning into like another passive income source for people who were traditionally in real estate or like finding other ways to like monetize property holdings. So maybe there's still more meat left on the bone there. Maybe this is like the right time to get in. I'm not the right person to make that call, but definitely try to see both sides of that coin if you're going to start to like put your hard-earned money and investments here. Maybe it's great. Maybe it's like the stock price appreciation has at least seemed very strong and great for the past decade. So if that continues, I mean, money printing, right?
Yeah. On the little research I did on that market, it looked like Canada has more room for growth. It looks like the US is a little bit more matured, but the self-storage space in Canada is still pretty largely untapped, but there's only one public stock for exposure to the space. And of course, everyone knows that is trading at like a 50 price to operating cash flow. So yeah, there's the problem. Everyone knows that's the one stock to own. In Canada.
Look where people aren't looking, right?
Yeah. But yeah, I think I should hop off. I think yeah, I'm getting text now, so it's time.
Sweet. I'll hand a little wrap up here. We said we were going to be live for a half hour. We have so much fun with you all. It has been an hour and 9 minutes. We have the famed text from Daniel's life manager, aka his lovely girlfriend. So thank you everyone for coming. This has been another great episode. We go live every Saturday at 11:30 a.m. EST, and we are obviously owning and operating Stock Unlock, where we are fellow users ourselves and having a ton of fun building this with you guys and forming community here. So thank you everyone for coming, and hope everyone has a beautiful Saturday.
Yeah, thank you for that outro, Jake. I just read the text. It is definitely time for me to go. So yeah, thank you everyone for tuning in. I'll see you all in the videos that I make this week. There will be Stock Unlock videos coming out this week, and yeah, stay tuned for those, and we will see you next week in the live stream. Hopefully Nick will be here and not be sick. Sick Nick.
Stock Talk, we out. I'm gonna press I think I can press the end button.
All right.
End.